Well, good morning and welcome to today's FS Club event. Our webinar today is entitled Liability-Driven Investment, Creating Liabilities. This is not a one-off topic. We are absolutely delighted to have back with us Dr. Con Keating, who has been one of the foremost thinkers on pensions and the race, and really the ratios between liabilities, between equities and investment in the long term. In particular, Con has written some probing critiques of areas such as discount rates, what to do about defined benefit pensions, and was absolutely fundamental in the creation, well, the recreation, arguably, of defined contribution, collective schemes. So absolutely fascinating stuff. So Con, we're delighted to have you back. You're continuing an argument, but in a sense, you've got a nice standoff thing today where what Con wants to cover is how effectively liability-driven investment is not actually hedging actual liabilities, but creating some, and Con has some very interesting ideas on the ways in which schemes believe that they're actually using mechanisms that are legal, but might actually be debt mechanisms. We'll come on to that. Now, you know me, I'm Michael Mainelli. I'm one of the directors of CN, and it is a privilege and a pleasure to be able to introduce so many of these webinars, and I can only do that thanks to our sponsors, copious sponsors globally, who help us on anything to do with technology, economics, and finance. So my sincere thanks to all of you, and I'm sure from the audience on allowing us to keep this program going. All of them, I think, have got an interest in pensions. Pensions are one of the biggest areas in our financial sector, and combined with the fact that Con's comments relate to just about anybody in investment and asset management, this is clearly of great importance to us. Now, the format today, as ever, is to have me leave the stage as soon as possible so that you can hear from Con, who is our expert today. Con's got about 20 minutes of presentation, but the great thing about these sessions is our ability to interact and ask questions. So we've got 20 minutes reserved for Q&A. So to pick off three quick things: yes, this is being recorded, and being quite a technical session, you may wish to review it, and it'll probably be going up just before the weekend. Secondly, we do have slides, and they are available. Con has a number of other writings which we'll be putting into the chat room and connecting with via the website holding page for this. But lastly, and most importantly, how do you get involved? How do you ask questions? Well, it's quite simple, really. Just type your question into the GoToWebinar chat room, and I will feed it into a conversation with Con. I might point out that Con will get all of your emails with your, all of your questions or comments or observations with your email attached. So if you just want to contact him or ask for some substance on a point of detail, just slip it in there as well, and we'll make sure that that gets to him. Now, just before we start, we thought we'd take a bit of a temperature of the audience. And in a way, this question is one where some of you may say, well, I came onto this to understand what liability-driven investment is in the first place, but liability-driven investment, does it enhance the security of a DB scheme over its life cycle? So in your opinion, is that yes, no, or are you unsure? Liability-driven investment, at least for a pension fund, is something that is, trying to gear up and meet the assurances made to pensioners and employees by focusing on the liability side. So there's no one agreed approach or definition for these taken in regard to LDI, but just have a quick go at answering the question now, and we will reveal the result in a moment. Con, as you know, our audience is really quite opinionated, so if you don't mind pulling the poll back at the moment. You've got about half the audience believing that it is not an enhancement. You've got a quarter of the audience believing it is, and you've got 28% unsure. I won't mention which 50% you're trying to sway here, but over to you, Con. The floor is very much yours. And if you wish, give us the answer to the question.
Yes, I will. Let me just share my screen and we can go away. I hope you can now see my slides.
Got them.
Good. Well, let's make one point right at the beginning. This is all joint work with Iain Clacher from Leeds University Business School. And on the question of questions and so on, please do put questions in as they arise, and perhaps Michael will interrupt the presentation where they are relevant for clarity or whatever. I do, as a matter of course, respond to all questions which come into the chat box or the Q&A function afterwards, as a matter of course. So let's go into a presentation. This is a quotation that Iain and I would just love to have actually existed, because it reflects what we actually think of a method of managing money and managing the liabilities of DB pension funds, which has lost all semblance of connection to reality. So let's begin with some legalities associated with DB pension funds. First of all, IOP 2 and the earlier IOP 1 both prohibit IOPs, that's pension schemes, from borrowing, other than for liquidity purposes on a temporary basis. Now, this is clear and unequivocal. The transposition of that to UK law is through the Occupational Pension Schemes investment regulations. And that again says you cannot borrow money, and it also tells you that the test of borrowing is that it's liable to be repaid out of the assets of the scheme. And there's an exemption for the purpose of providing liquidity on a temporary basis. I'm going to make the point later that the levels of borrowing that we have seen far exceed anything that could be considered to be for a liquidity purpose, and indeed are far from temporary in nature. They have been steadily increasing. Borrowing has been steadily increasing since at least 2015. Can we go to the next slide? Right, let's just deal then with the law on derivatives. Basically, the IORP directive says that investment in derivative instruments should be possible in order to reduce risks, investment risks. The transposition to UK law does not contain that investment risk reduction wording, but I think that most lawyers would agree that in interpreting the UK law, they would actually read the original document and on a purposive basis read investment risk into that. That raises questions as to whether or not you could in fact justify the hedging of liabilities in the way that we are. These are not risks contained within the investment portfolio, and that could be problematic. Now I'm just going to leave that hanging, and we won't in essence be discussing that because there are some more evident problems that we need to deal with. Can we go to the next slide? So what constitutes borrowing? Well, the obvious ones: borrowing from a bank, issuing notes or bonds, although it's not schemes that issue bonds, but companies have in fact been known to issue bonds to use the proceeds to fill gaps. Marks and Spencer's is probably the poster child for having done that. They raised £400 million in order to fund their scheme. Now, the next form, and in fact the largest used form of borrowing, is repo. Economically, that's secured borrowing. It effectively subordinates the interests of key members with respect to the assets which are repoed. It is very widely used. The repurchase leg clearly satisfies the statute implied test of borrowing of repayment from scheme assets. Schemes have actually been borrowing for very long terms and in amounts far in excess of their liquidity needs. USS is perhaps a poster child because simply the numbers are publicly available. Their level of leverage of borrowing has been about 4 to 5 times their annual pension payments. And they were actually recently proposing to increase that to around 10 to 12 times. So they were talking about taking their leverage from 120% to about 140%. The question really then is, and it's a critical question, is repo borrowing? Clearly, economically, it is. And what are the opinions of various other people? Well, you've got ICMA, the Capital Markets Association, who actually say that the principal use of repo is in fact the secured borrowing of lending of cash. And you've got the Federal Reserve in their description of repo saying that repo financing has been used by the Federal Reserve to provide credit to member banks since 1917. Now, I would say that they are pretty powerful supporters of the idea that repo is borrowing. So can we go to the next slide? What with derivatives? Well, reverse repo is borrowing of the security. Short selling is also borrowing of the security, which should imply that schemes cannot short sell. I'm not actually aware of any that do short sell, but I would think that that serves as a prohibition on them. Now, derivatives such as interest rate swaps, when they're fairly priced, involve no exchange of cash, but they will be subject to collateral maintenance margins, reflecting the profit and loss. And there's an article in today's Financial Times talking about just that, because the collateral calls that have been coming in on the interest rate swaps and the inflation hedges, the inflation swaps, have been quite huge. Now, the thing about the cash margin is, if you are margining or putting up collateral here, the important thing to understand is that that is an advance on an expected future profit. If it is spent on, for example, the purchase of other securities, then it's borrowing. That means that if you're operating a netting regime with your counterparties, and you will be operating netting regimes if you are using a central counterparty, a CCP, for margin maintenance, then it's borrowing. This thing about borrowing is, this is actually the reason that we have rehypothecation rights within derivatives securities or within derivatives contracts to permit the reuse of non-cash collateral. Let's go to the next page. The question then is, are repos derivatives? Because they might feasibly go through that derivatives hole if they are. Now, there's no mainstream text that makes that claim. We did a search and we found only one paper that supports that idea, and it's a pretty weak paper. I cite it there. EMIR actually defines a derivative as a financial contract linked to the fluctuation in price of an underlying asset or basket of assets. Now, Repos are not derivatives. They are not derivatives of the underlying, but rather operations on those securities for the purpose of borrowing money. Okay. We did find one reference. We have written to the Pensions Regulator asking them to expand or explain why they are allowing the use of repo to the extent that they are. And it's very substantial indeed. It's around 20% of all scheme assets. The point is that the only reference we found to repos being derivatives is in the PPF stress test determination, where they actually state that repos are derivatives. We've written to and spoken with them, and they actually don't hold that position. That was just shorthand to ensure that repos were captured within their stress testing. So we really do not believe they are derivatives, and we would like to see how then is it that these things can be being used in the way that they are. Let's go to the next slide. Change of topic and just talk about the other thing which goes on in liability-driven investment. And this is principally the hedging of the discount rate. Interest rates do not figure in the determination of the pensions ultimately payable. They are not a determinant of the actual pensions that will be received by members or the ultimate liabilities of the scheme. All of those rates do is determine a present value. The next bullet point is simply that Iain and I have made the point on numerous occasions that there is a natural discount rate implied in any pension contract, and it's derived from the contribution that was made and the projection of the liabilities that are resulting from that award. The next point to note is that discount rates are being very widely assumed to be gilt related all over the place. And there's actually no relationship worth talking about between gilt use and equity market performance. So the gilts plus formulations of discount rates are questionable in extreme. Hedging using conventional gilts, which is what actually is done by everyone within LDI, and if they're not hedging using gilts, then they are using a close surrogate in the form of an interest rate swap, where they're receiving a gilt yield. Hedging using conventional gilts actually introduces a dependence on the performance of gilts into the scheme. That's not a good idea. Schemes will win when rates decline, and we've had 40 years of steadily declining interest rates, and it's only been in the last year and a half that we've seen rates begin to go back up again, and it looks as if they may yet have further to go.
Yeah.
Hedging the discount rate by buying gilts does nothing to improve the likelihood of paying pensions fully when they are due. Gilts will yield much less than other private sector assets. Borrowing to finance the purpose of the purchase of gilts is simply compounding that sin. So let's go to the next slide. Here's some relationships between linkers and other variables. What I show on the left-hand chart is the relationship between the returns on 15-year plus index-linked gilts and RPI. There is no relationship evident. Okay, those are annual returns. Then I look at the relationship in the bottom right-hand corner, the relationship between 15-year conventional gilts and 15+ year index-linked securities. And you'll see that there is rather a strong relationship. It's not evident from using those two indices, but basically an index-linked gilt is a conventional gilt on steroids. Can we go to the next slide? This is how index-linked gilts have performed. There's a selection of 5, I believe, here, from the 5-year, or no, the 7-year through to the 2068. I also show the performance of RPI over this time. The interesting point to note is, at the time that I prepared this graph, the 2068 had fallen by about 40% from its all-time high. Since then, it's fallen further. The 2068 linker would now be breaking the bottom axis on that chart. The peak to trough decline of the 2068 is over 60% in price. The peak to trough of the 2073 is over 70%. Index-linked gilt spreads have moved markedly. Can we go to the next slide? This shows the real yield of the overall market in index-linked gilts over time. It goes to 2021, and you see that we saw basically the spread to CPI or RPI being as low as 2.5% below CPI. Now, why a pension scheme should want to buy inflation less 2.5% was a complete mystery to us. The correction we have seen this year has led us back to, these spreads are now back to between 3/8 of a basis point, 38 basis points, and 50 basis points of that order of magnitude. In other words, we have given up all of the gains made since 2013 in the space of 6 short months. Can we go to the next slide? These are break-even yields implicit in market pricing of index-linked gilts, and they're obviously relative to, oh, can we click again? And there were some words on this slide, but they don't seem to be there. Click again as well, not quite sure. Anyway, that's just an explanation of what a break-even yield is. To give you an idea that since this slide was prepared, which was back in late April, we have seen the break-even yield on the long gilt decline to slightly pennies over 3% as we see long gilt yields rise to around 260, 270. Let's go to the next slide. The point about a break-even yield to understand is that this is the point where you are equal to holding the conventional gilt. You need to earn more than these yields in order to have any form of meaningful inflation cover. So the schemes are borrowing, there's no doubt about that. The PPF reports 9.5% net cash in the universe of pension schemes overall. Now, all of that cash is actually borrowed by schemes over 100 million in size. If you consider the fact that they need operating balances of 4 to 5%, that means that we are seeing borrowing of at least 12 and probably more likely 20% or so of the total value of scheme assets. Now, all assets have gone down in the period in the first 6 months of this year. So if you are 120% leveraged, or sorry, 1.2 times leveraged, then you have lost whatever it is, 20% or so on your additional 20%. You have acquired additional risks, which are almost certainly ultra vires for pension schemes. The schemes are allocating assets, hedging elements, which don't affect pension schemes, interest rates. Schemes are buying assets which increase volatility with no commensurate expectation of gain. Linkers are the classic example. If I look at, but it doesn't need to just look at linkers. I can just look at the volatility of bonds versus equity. The MOVE index in the last 2 years has gone from a volatility implicit of 10% to something around 80, while the VIX, i.e. equity volatility, has gone from around 15 to 20% to sort of 25 to 30%. These operations have introduced volatility into the scheme's actual values. In other words, and when you do that, you are inevitably buying assets which increase the cost of pension provision. The more gilts you buy, the more you need the residual assets to work harder. And there's no way of making that happen. Trustees really should be aware of all of these risks. And so too do LDI managers, because the law as it exists includes liabilities for them. And it's not at all sure that the contracts which try to remove those liabilities would be effective in a court. And most importantly, TPR must explain why it's not enforcing the law. So let's just go to one last slide, which perhaps explains the nature of the problem in really Toy Town terms. So think of a scheme that has projected liabilities of say 120 million, and it has the present value of those liabilities is 75 million. We'll call it technical provisions. The scheme has assets of 75 million. The scheme's in balance. Now, let's suppose the discount rate rises. Doesn't matter why, but the present value of liabilities is now 60 million. And assets fall by design because we had a perfect LDI strategy to 60 million. All else is unchanged. The scheme's again in balance. But here's the risk. The level of funding relative to the true liabilities has fallen from 62.5%, 75 million, to 50%, 60 million. The scheme is much less likely to be able to meet the ultimate required pension payments. And that frankly raises the spectre of disgruntled members taking action against trustees for breach of fiduciary duty. I'll leave that's the end of the presentation and throw everything open to questions. Actually, I think we have a question, do we not, Michael?
We do, but just before we come to that, Con, would you mind, just for a couple of people, just a short re-explanation of the repos? Because a lot of people aren't deep into that market. So just what a repo is before we head to that question.
Sorry. A repo is really a very simple transaction. What it does is, what you are doing is you are selling a security to a counterparty at the same time as agreeing to buy it back at a future date, say 7 days from now, at a price which reflects the cost of borrowing money over that period of time. So you're borrowing the cash to finance a position You're doing it by appearing to sell the gilt or the collateral you're putting up to buy it back. I mean, one way of thinking it, just think of it as pawnbroking. That's pawn, P-A-W-N, not P-O-R-N. In essence, the accounting for repo makes clear what's going on. You are maintaining the economic exposure to that gilt, if it's a gilt that's being repoed over its lifetime, because although you have sold it, you are buying it back at a fixed price today, and a fixed price which only represents the cost of financing, the cost of money.
Well, that leads us then on to the question. So folks, do you believe that repo is borrowing, yes or no? The way you explained it, Con, was perfect. It sounded like an Islamic finance setup.
Well, no, I don't. You've actually just left me with a good idea. I'm now going to go off and check with an Islamic scholar how they treat repo. Thank you, Michael.
Good. And here is the answer. So you've really convinced the audience, 90% saying yes, they do believe that it's borrowing. And I
will say, I'm told that there is a legal opinion doing the rounds which says that repo is not borrowing. I have not been able to track down the source of that legal opinion. I would really like to see it, because Ian and I recently spent 3 3/4 hours in Lincoln's Inn Fields and over a very memorable lunch, but discussing with eminent pensions law and securities law people the precise position on this stuff, and we don't see how there's a valid opinion to the effect that repo is not borrowing.
Now, let me just
say that from the standpoint of a trustee, having an opinion does not remove your obligation and potential liabilities under fiduciary duty. The existence of the opinion does not mean that this is how a thing will actually be treated in court. The opinion is merely one way in which it may be treated in court.
Okay, so just in summary, you are basically saying that the conclusion of your stuff that I pick up is I really shouldn't be buying gilts at all anyway, but even if I do, at least I shouldn't be buying ILGs either, so it's kind of a double whammy. Now, a lot of contrarians would say, well, that's great, but that slide that you showed us about the break-even rates on the ILGs is one where I would sit there and say, oh, well, that's going to reverse at one point. And Con was right over the period from 85 to 2021, but with inflation rising so rapidly, that's all history, and now these are even more important.
Well, I will just say that we have been consistent in our criticism of people buying linkers at 200, 300 under RPI. And we've been projecting a correction to that for a very long time. It's only been the persistent buying from the pensions world which kept gilts up. I think the index-linked gilt market is now going to experience the same sort of subsequent price performance we saw from the Japanese stock market. The Japanese stock market got in the late 1980s to insanely expensive levels. It then collapsed, and it has never regained those heights. There really isn't the demand out there from the pensions world to go and buy gilts back up to the extent that we saw over that period.
Well, let's take a few comments here. take a few comments. John Spain says allegedly gilt yields are there to provide prudence, but they don't do that because prudence can only be identified by reference to best estimates, which I think is there. And as for ILGs, especially older ones with higher coupons, they really just don't match future pension cash flows. And he believes that the LDI advisors should be explaining themselves, not just the managers.
Yes, I hadn't thought about including LDI managers in the discussion here, but yes, I think he's correct. Is he correct on best estimate to have prudence? Yes, I think you do need to know what the best estimate is in order to know the degree of prudence you are applying in these things. I think one has to be very careful not to be recklessly prudent and to drive things out of sight. But the principal problem with buying gilts is the arguments that gilts and equities diversify one another in extreme situations is actually very weak. We've just seen a period where equities collapsed, as also did bonds. As it happens, bonds have gone down by a bit more than equities, but they certainly serve no purpose as a risk diversification. And if you are buying conventional gilts at 300 or 400 basis points below inflation, then you are not going to be doing anything to enhance the quality of the pension scheme. You're actually going to be making it insanely expensive.
Yeah. Jeremy Light is curious, to what extent are defined benefit schemes obliged to buy gilts?
Not at all. There is no regulation which specifies that you have to buy any form of security. There's a lot of pressure. There's a lot of pressure brought to bear by the Pensions Regulator, but the Pensions Regulator could not impose a requirement on you to buy gilts. They do not have that power.
I think some of that varies outside of the UK. I mean, certainly I was...
No, there are other countries where there are explicit limitations and requirements on what you can and can't buy. I'll give you a classic example where there's a whole tier of requirements. That's for Kenyan pension schemes. Just happens I've been doing some work on Kenyan schemes recently.
Yeah, and I've seen some US schemes where state by state, they're even required to buy state bonds, believe it or not, to some proportion.
Yes, I've even seen state funds or state-related funds where there is a local investment content. One of the things, of course, which is quite commonplace in state funds is minority inclusion clauses. You have to preferentially invest in minority-owned businesses.
Now, Derek Scott has an interesting observation. He says that the IORPs and the 2005 investment regs also refer to efficient portfolio management. And what does that mean? And do these words excuse the historical use of liability-driven investment in the UK?
The answer is I don't think so, Derek. The interesting thing is the management under the IORP is of investment risks. If what you are allowed to manage is investment risk, then you cannot be running the portfolio to hedge a liability risk, because the portfolio, the investment risks apply only to the assets. Now, can you describe a portfolio as being efficient if it results in lower coverage of the ultimate liabilities? And I think the answer to that is a resounding no. You may see that you could buy the assets out more easily because most bulk annuity players price their annuity levels related to gilts, but that's a level of pricing which bears no resemblance to the company's original liability or the company's ongoing liability. It's a change of emphasis that's unwarranted. Yeah, one of the questions I have raised on this alternate objectives front has been this. Pension schemes were created and trustees given a mandate to run the pension scheme, okay, and to run it on an ongoing basis. They were not given a mandate to take the pension scheme off at some point in time and sell it to the world's latest bulk annuity player.
Yeah.
Who's probably reinsuring with someone you've never heard of in a country where there's a lot of bananas and temperatures like we now know in London.
Well, let me just, we're coming to time, a few things. Chris Giles, I think you'd agree with this. LDI strategies are inappropriate because DB schemes should be managed on a cash flow basis. The discount process is flawed. And pension schemes, on the other hand, need to be able to invest in a combination of equities paying dividends and annuities and gilts bonds to generate a predictable revenue stream. So there's the revenue stream argument as well.
I think I wouldn't say that pension schemes have to be managed on a cash flow basis, but I would certainly say that pension schemes could be better managed on a cash flow basis than they are under LDI.
Good. Now, just to kind of close off on a couple of points, Chris Flood says, what do you think, Con, the regulator should do, as the Pensions Regulator doesn't appear to see any fundamental problems with LDI, and it says its remit is to ensure that trustees meet fiduciary duty. So are the issues you raise actually within the regulatory ambit of the Pensions Regulator? And a kind of a concluding question or sort of snide remark from Marcus Johnson.
Look,
does anyone?
No. The Pensions Regulator's ambit does not stretch to ensuring that trustees operate within fiduciary duty. The Pensions Regulator's job is to apply the law as it exists. Mm-hmm. And to my mind, they are not doing that with repo. Good. Once they have resolved the borrowing aspect of repo, then we can go on to consider some of the other aspects. One of the things which is truly scary is the extent of collateral calls on there are no collateral calls, by the way, on repo. All you will see on repo is refinancing terms changing unfavorably to you. The collateral calls that matter are those which arise from derivatives contracts. Today's FT seems to suggest that there's 1.5 trillion of derivatives contracts held by the UK DB sector. I suspect that is too high an estimate. I would put the number closer to 1 to 1.2 trillion, by the way. But with 20, 30, 40% collateral calls on those derivatives, that's 200, 300, 400 billion of cash or high quality liquid assets being called away as collateral to the counterparties. Yeah. And of course, outside of the grasp of pension scheme members. And also, most importantly, in terms of TPR objectives, outside of the grasp of the pensions regulators, the Pension Protection Fund, should the scheme fail.
Con, we've come to time. I think this has been excellent. You've really reinforced the point that these this idea of liability-driven investment is not actually hedging actual liabilities, and you've made a compelling case for why are we allowing repo to feature in this. I actually, with more time, would have loved to pick up some of the implications of both short selling and perhaps also some of the political implications of, what's the government going to do if there aren't people to buy its bonds, which I think sometimes underpins some of the moral hazard in this space. But may I say, as ever, an enormous thank you.
Can I just put one request in? There was one person who, or one or more persons, who said that they thought repo was not borrowing. I'd love them to drop me an email and explain why they think that. If I've missed an argument, if Ian and I have missed an argument, it's important that we find out what it is.
Good. Well, folks, that's very easy.
If someone
put a note into the chat room now saying, Con, I think. Put a note in the chat room now saying, Con, I think you're wrong, or tell Con what a good job he did, because either way we'll get those messages to him. The very sincere thanks to the audience. It's been a small audience today, just 30 of you, but absolutely great, because on this topic I wasn't expecting a large one, but we think the topic is extremely important and needs to be put in front of the pensions regulator again and again until we do get some of those answers. As ever, do check out the website. May I thank in turn, of course, our sponsors. You're always wonderful in allowing us to explore these topics, especially ones like this where there's an uncomfortable challenging to a cozy status quo. And I think it's great that Con is challenging that. But as ever, Con, our thanks to you. You are a leading light in long-term investment and liabilities and in pensions. And we really admire the hard work that you do unpaid just to help improve the sector. So thank you very much for coming on and sharing your views.